Hi again. Thank you for joining our webinar on revenue recognition. The revenue recognition module has been a part of Priority for over 2 years since version 20.1. If this is the first time that you have heard about it, I strongly recommend you to watch the first webinar, which covers the fundamentals of this module, and then revisit this webinar. Tomorrow, we will send all attendees recordings of the first and the current webinar. Today, we will discuss advanced topics and additions to the recent versions. So, what is the agenda for today? We will quickly recap what revenue recognition is in general and what revenue recognition is in Priority. I will explain the difference between unbilled and deferred revenue and when the system will use each one of these accounts. I will explain the concept of fair value allocation and the various tools to allocate the share value. And finally, I will do a demo with some examples. And at the end, like always, I will answer your questions. I remind you that you'll be able to write your questions in the question box on the bottom right of your screen during the webinar. I will review your questions at the end and answer the relevant questions for all attendees. So, what is a revenue recognition? Revenue recognition, commonly referred as a rev rec, is the accounting practice of shifting revenue from deferred and unbilled revenue accounts into actual revenue. Without having rev rec implemented in a given company, revenue is registered directly to the revenue ledger when billing occurs. But accounting rules, ACS 606, which our module follows, introduce several rules on principle and timing of when and how much revenue can be recognized by the business. As you can see on the slide on the first block, the fundamentals of this in Priority are the document representing the contract obligations with the customer. For that purpose, we use sales order or sales invoices. Either one can represent the contract obligations. The line items are the contract obligations themselves, and against each of them, we need to identify the principle and timing of the recognition, and we need to define the period and the price of the contract obligation. When we have all of them, we can allocate fair value to the contract obligation, and as a result, we can recognize revenue. I will show you all this process during the demo. Another topic that I want to discuss today is unbilled revenue versus deferred revenue. Here on the slide, we can see 3 points in time when the system behaves differently. The first point in time is the event when revenue is recognized before billing. That means that no invoice is placed yet, and maybe part of the revenue needs to be recognized. In this case, the system will shift it from unbilled revenue to revenue. At the bottom of the slide, we can see the second point in time, which is the billing point. Maybe at this point in time, part or all the revenue is already recognized. In this case, the system will credit the unbilled recognized and credit the deferred for the part that was not yet recognized. So we understand that the system distinguishes between the various amounts. Finally, the last point in time happens when revenue is recognized after the billing point. In this case, the contract obligation has already been billed in full. The system recognized the revenue by shifting it from the deferred revenue, which is the kind of revenue we recognize after the billing point, to revenue. In the demo, I will show you these 3 points in time and how they are represented in the ledger. Another topic that I want to discuss today is fair value allocation. Fair value allocation is essentially the process of assigning a true value to contract obligation items based on the actual effort required by the business to deliver that obligation. For example, if we are a business that sells software license and we have a single sales order line of software license with value. Behind the scenes, from an accounting standpoint and the way our organization operates, this line item represents more than that. There is the software itself, there is the maintenance for that software, and there is the element of the cloud hosting. Now, we want to know the fair value of each of those components out of the value of this specific line item. So Priority offers few ways to allocate fair value. The main steps are to describe which level to which entity and how the calculation will take place. So the first column on the left describes the fair value level, and we have two options. We can allocate the value of the entire allocation. So, for example, if we have a sales order with two lines, one with $1,000 and the other one with $5,000, the total is $6,000. For purpose of RevRec, we can spread those $6,000 among two lines differently. I can allocate $3,000 for the first and $3,000 for the second. Instead, we can allocate fair value to contract obligation items, which means components. What do components mean? As I mentioned in my previous example, we can break down that software license into software, maintenance, and cloud, and allocate each value to the components. The second level is the entity that allocates the fair value. We can look at the contract obligation item as a part number itself on the sales order or invoice line, or we can look at it as a bundle and break it down into several components, as mentioned in the example with the software and their components. The last thing is how the fair value is calculated. Of course, we have the manual way, which is written here on the bottom because it's the most straightforward, but least automated to do it. But further than that, we have automation to calculate the fair value. One type of calculation is the ratio of the main component price on the price list to the entire contract value and the remainder. The other type of calculation is that we have all the components on the price list. Fair value is the ratio between the components of the contract obligation. We will see these calculation types on our demo. So now it's an excellent time to shift to the demo. I prepare in advance a few sales orders that are in fact contract obligations for our discussion. And just a second, I have some connection problems. Okay, now it's everything okay. So as I told you, I prepare in advance a few sales orders for these examples. So the first example that I want to show you is the difference between the unbilled and deferred revenue. And as I mentioned on the slide, we will see those 3 points in time. So I have a sales order with $24,000 here. And we can see that this order logged in June 12. In the contract obligation items here, we can see the RevRec conditions. The term of the RevRec principle is equal payment. We can see that the entire amount will be spread over 4 years here. The RevRec timing set to immediate means that as soon as I convert this sales order into a confirmed status, the RevRec execution process kicks in. So based on my definitions, let's see what the system has planned for this contract obligation. From the sales order, I will click on the action Revenue Recognition Planning and shift to the Revenue Recognition Planning form. On the sub level of the form, we can see that the system created a plan that starts at the end of June and will be for 48 months. The end of June and will be for 48 months, as I said. So the next step that I need to do is running the recognized revenue program up to the end of June. I can do it from the menu or from my home page. This is it. Because I already prepared all of this in advance, let's see the event resulting from running that program. So we can see here that we have one journal entry that was logged. And if I dive into this journal, we can see that the system shifted the first $500 recognized amount from the unbilled account to the income account. And why is that? If you remember the slide with the timeline, we are on the first time slot when RevRec happens before billing. At this point, there wasn't any billing against this sales order, and that's why the unbilled receivable account was chosen. Then, let's go back to this form, okay? Then I created an invoice, and we can see this in our new sub-level form called invoices. This invoice is for the entire order for $24,000, these 2 lines. But because there was already a RevRec for $500, the way the system booked the invoices is like that. $500 against the unbilled receivable, and then what is left is on the deferred income. By the way, the invoice sub-level form that I'm using here is a new form from our latest version 22.0, and it makes it easier to trace the RevRec events that happened against this order line. Let's jump to the future, to the end of July, when I will run the recognized revenue program up to the end of July. And as a result of that, I'm going back again to the revenue recognition progress. The third event represents the last time slot, will be this journal entry. So this RevRec takes place after the billing occurred. And if I dive into this journal, we will find that the system has chosen the deferred income account and shifted the amount into the income. So till now, we have seen the 3 points in time and so how the system behaved differently. Going back to the sales orders. Okay, so in the next example, I will show you aspects of fair value allocation. I will start with the manual fair value allocation. So I have this part here, cloud license, and if I will dive into his financial parameters for part, where we can find the definitions of the fair value allocation, the first thing that I need to do is to define the RevRec rule, as you can see it here now, as a fair value allocation, or in short, FVA. Once I set up the rule FVA, I have the option to set it on the sub-level form FVA components here, as we can see it here. There I set 2 components. We have the license and the maintenance. The license represents the software itself that I sold to the customer, and we know that the customer gets and uses the software immediately. So that is why the RevRec rule for this component will be full, which means the full amount on day 1, and the RevRec timing is immediate. But the second line, the maintenance, is spread over a period of time. On the sales order, you didn't see that, but I sold 12 months of maintenance. That is why the RevRec rule for this component will be equal payments, okay? Equal, and it will be equal payments over time. And again, the RevRec timing is immediate. Please note that I manually allocated the ratio between the component 80% for the license and 20% for the maintenance. So let's go back to that order line. So we can see that we have here 5 licenses, $200 each, spread over 12 months, as I mentioned. Okay. So we have $1,000 for this contract obligation. We can see on the sub-level form called FVA components that the system automatically recorded the components that I set. Still, I want to show you that I can change the ratio manually for that particular line. You can see it was 80-20 and now it's 75 and 25. I decided to allocate 75 for the licenses and 25 for the maintenance because I have some knowledge of this specific order that may require a higher level of maintenance than the usual. That's why I can allocate it manually. Let's go back to the header of the sales order, and from there to the action which will shift us to the revenue recognition planning form. Just like we did on the previous example, here we can find that the system created two plans for this order line, one for each component, one for the license and the second for the maintenance. So we can see on the license line that the amount written on the allocation sum here is $750, which is 75% of $1,000. And we can see on the sub-level form that they were recognized at the end of May when the order was confirmed. And what was left will be the maintenance, the second line here, spread over 12 months and recognized monthly. Let's see it on the sub-level form. So this is about it, how the fair value is allocated manually. Now I want to move to the third example. Again, I'm going back to the sales order form. Now I want to show you how we can utilize more options in the system. On the first line of this order, we have a part called Cloud License Main Component. And then let's see if I will dive into his financial parameters for parts. We will see that his revenue accrual will be FVA1, which is actually the ratio of list price, means that the system will calculate the ratio for the main component from the price list, and the rest goes to the remainder. The components on the sub-level form are the same. I have the license and the maintenance. This time I just said 50%. You can see I just said 50% of fair value allocation to each. Still, those percentages are completely unimportant because the ratio of the fair value allocation will be calculated once the sales order item will be recorded, not like the manual way. So going back to the sales order, what I've done here, we can see that I've sold one license for $500, okay? We can see on the sub-level form, FVA components here, that the system automatically calculated the fair value allocation percentages. You can see. And how did the system do that? So first of all, let's check the prices on the price list. I will open the form. This is the relevant price list, and we can see that the license is $150. And for the maintenance, we don't have a fixed price on the price list. So let's go back to the sales order. So $150 from the price list out of $500, which is the price for this line item, the system calculated 30% for this component. The rest go to the second item, which doesn't have a fixed price on the price list, as we saw, because it represents the rest of whatever needs to complete the 100%. And in this case, it's 70%. So that's another way to calculate fair value based on main components and their remainder. Another way of calculating fair value is relative to the bundle's components. I use the same order for the next example, but now we will talk about the second line. So if I go again to the financial parameters for parts for this part, you can see that I specify the revenue recognition rule to be FVA2, which is the ratio among items by the price list. Let's see my FBA components. I have the license, and now I have an app called second app. Okay, so under this part, I sell license and app. Again, randomly, I just put 50% of their fair value on each one because it makes no difference. It will be calculated automatically at runtime based on the prices from the price list. Let's go to the price list and see how much the second app, what is the price for the second app. Going back to the price list. So we already know that the license is $150 and the second app is $30. Let's go back to the sales order. Hope you're still with me. Okay. Okay, in this case, it doesn't matter at all what the unit price, as you can see it here, I have a unit price of 180, or the quantity, or the total line item, because the system takes the ratios between the items in the bundle from the price list. So according to the ratio in the price list, let's go to the much more expensive license received. We can see here the much more expensive license received 83%, and the second app that is much cheaper received only 60% of the fair value. Still, like always, you can manually change those automatic calculation at the sales order or invoice item line. But the whole idea of using it is to enjoy the automation in which the fair value is calculated automatically on a rule-based system that is driving the information from the price list, which maintained by the company. Now again, if we will go into the revenue recognition planning, I'll go back to the header. We will find 4 lines to be recognized. 2 for each sales order line, because each item has 2 components and their breakdowns on the sub-level forms. Sorry, I meant to go back to the sales order, to our last example for today. The last example that I want to show you today is the calculation of fair value among components of the contract obligation itself, which means directly from the sales order line. So for example, I sell some pieces of software, and when I'm selling it, I have my license to sell for the platform, and then I want to offer the user to choose any 2 apps from my marketplace. Let's say my marketplace has 10 apps. I tell the customer you can choose any 2 apps for $25. So essentially, I've sold them 12 licenses for a price of $150. We can see it here, okay? And $25 for this bundle, 2 apps bundle. So unlike the previous cases, we can see that this is here on the line items, we have the actual components, the license and the bundle of 2 apps. Now, when I want to recognize revenue based on the actual apps that the customer ended up choosing, each app has its value and its price on the price list. In order to calculate this fair value, I use a new form, listen. I use the FBA components for documents. This is a tab level form of the order. You see it here, FVA components for documents. Here I can specify which components to recognize revenue for this contract obligation. So for the first line, the license, I choose the part number of the license. It will recognize revenue for itself. It stands on its own. But for the second line, I want to specify which two apps the customer has chosen in the bundle. So in this case, we can see that they decided on app number 1 and app number 3. Okay, the first app and the third app. So of course, those apps have prices on my price list, but again, we can see that the system calculated, we will see in a second that the system calculated those fair value allocations. Let's see how we can do it. So after I'm done entering all the items into the order and specifying the components on this form, what I will do, I will run the program from the actions menu here that's called set fair value allocation in documents. Let's click on it. Here I can specify which, forgot to do something here, just a second. Okay, sorry. So here I can specify which price list I want to use for the fair value allocation. You can see it here. And I can specify what revenue accrual I will use for the calculation. I have two options, FVA1 or FVA2. So the primary, we can select between the primary component or the ratio between components. I choose now the ratio between components, the FVA2, because I have 3 components here, and I want to use the ratio between 3 of them. Then let's click OK, and the system calculates the fair value. We'll see it in a second here. Now we can see the results. Okay, this is the fair value based on the price list and the ratio between them. The last thing that I want to show you is the revenue recognition form for this specific order. So I'm going to the revenue recognition planning. So because I have 3 components for recognition for this sales order, sorry, I didn't do something. This is what happens in live demo. So just a second. So as I told you, the last thing that I want to show you is the revenue recognition planning. Because I have some connection problems. Just a second. Hopefully it will be finished in this minute. Okay, so again, okay, so because I have 3 components for the recognition for this order, I will find 3 plans. As you can see it here, I don't know why my Outlook is open, sorry. Okay, so so we have 3 components. We have the license, the app number 1 and the app number 3, and each one has its own revenue allocated according to the calculation. And that's it for this example of a fair value allocation. Let me check your questions now. Just a second, please. Okay, I can see that we have just one question for today's session. The question is, on which levels the deferred and unbilled revenue accounts can be defined. So we have few options. We have the company level, we have the customer group level, we have the part accounting family level, and we have the combination of accounting family and warehouse level. So this is about it. So thank you very much for joining this webinar. I hope you learned something new. I hope to see you in our next webinar about the personalization and multi-company management of serial numbers. And have a good day. Thank you for joining. Ciao.